Good morning, everybody. Thank you for joining us along on today's webinar. My name is Sam Peacock. I'm the Business Development Manager here at Landmark. And today we're going to be looking at how you can deal with foreign nationals when it comes to anti-money laundering compliance. As ever, you need to be demonstrating to HMRC that you are taking a risk-based approach to money laundering risk in your business. So today we're going to look at the different challenges presented by foreign nationals and what tools there are available to help us to comply. Hopefully I will be able to give you a good steer on this, but as I said, if you do have any questions, then please feel free to contact me at the end of this. So let's get started. So, HMRC, who regulates AML compliance for estate agents, have released guidance which outlines their expectations when it comes to anti-money laundering compliance. In recent weeks, issues of how to deal with foreign investors and those not resident in the UK has hit the headlines. Statistics from the recent Property Mark National Conference laid bare the risk to estate agents. So over here you can see over 90,000 land titles are held by overseas companies. You're looking at 170 billion worth of property is held by 30,000 companies or trusts based in tax havens. So quite sort of shocking figures there. And while London poses the highest risk, with 57% of homes in prime central London and 36% of all homes in Greater London purchased by foreign buyers, there is evidence of property being purchased with criminal funds up and down the country. In 2018, an accountant in Wales was jailed for laundering 1.7 million through property and cars. Zamira Hajiva was subject to the UK's first unexplained wealth order after spending 16 million in Harrods over 10 years, alongside purchasing a £15 million home in London and a Berkshire golf course. Illegal funds from so-called county lines was used to purchase 6 houses in the West Midlands and Mid Wales through third parties. An analysis money laundering behaviour undertaken by the government in the National Risk Assessment of Money Laundering and Terrorist Financing identified that 27% of cases highlighted the presence of companies and trusts in property transactions. 36% highlighted attempted use of professional intermediaries, and 17% reported high cash payments. And the key typologies identified from suspicious activity reports, or SARS as they're more commonly known, were unusual transactions relating to the same property in rapid succession, often involving the use of cash or third-party intermediaries, and the use of companies or overseas trusts to conceal property ownership. In addition to the launch of the Flag It Up campaign, which is the latest government initiative to raise the profile of efforts to battle money laundering, HMRC are clear that property is under scrutiny, acknowledging that alongside solicitors, the estate agents are a key facilitator in a property sale, as you come into contact with both parties to the transaction at an early stage, and so you are in an ideal position to identify suspicious activity. There is somewhere in the region of 100 billion laundered through the UK every year, so the scrutiny isn't going away anytime soon. You might have seen the news yesterday regarding the publishing of the details of the fines levied on estate agents for non-compliance. So, as you can see, this problem isn't going away anytime soon. Foreign nationals and non-UK residents fall into two broad categories, those who are resident in the UK and those who aren't. Typically, due diligence on foreign nationals resident in the UK is broadly similar to UK nationals living in the UK. For an example, an Eastern European family settling in the UK. In such cases, it is likely that customer due diligence can be applied. This is unless other factors in the transaction arouse suspicion. Where a higher risk is identified, for example, significant cash payments, unusually large or complex transactions, properties bought through multiple companies to hide assets, and so on. In such cases, your risk assessments should identify that enhanced due diligence is undertaken. According to HMRC, typical measures that can be applied over and above those applied under client due diligence include obtaining additional information or evidence to establish the identity, You could take additional measures to verify the original documents supplied. You could ensure that the first payment is made through a bank account in the name of the seller or the buyer. Take more steps to understand the history, the ownership and the financial situation of the parties to the transaction. In the case of a politically exposed person, you could establish the source of wealth and source of funds. Or you could carry out more scrutiny of the business relationship and satisfy yourself that it is consistent with the stated purpose. Customer due diligence. So where you encounter an overseas vendor or purchaser or have an existing overseas landlord who decides to sell their property, this is where things can get trickier. Where a low or medium risk client is identified, customer due diligence can be applied. Typical examples where you have an existing client you've met or you have a pre-existing relationship with them that you could cite in your risk assessment. As long as you have a record of the due diligence when your relationship started and nothing else has changed. It is likely your client risk will be low normal risk and you can complete customer due diligence in line with your procedures. A member of the non-resident landlord scheme is someone who owns a rental property but spends more than 6 months of the year living outside the UK. Under the scheme, a landlord can have a UK tax residence, but their usual place of abode in another country. Non-resident landlords are registered with HMRC, which may be used to evidence a lower risk when it comes to applying due diligence. So looking at enhanced due diligence now, well, where a new client is resident overseas and or cannot be seen face-to-face, then enhanced due diligence must be undertaken. How this applies or differs from your standard customer due diligence, it should be outlined in your risk assessment and your anti-money laundering policy. So for clients who do not live in the UK, HMRC advise you should obtain the same types of identity documents for non-UK residents as for UK residents. If you have concerns that an identity document might not be genuine, then contact the relevant embassy or consulate or use the link to Prado below. If documents are in a foreign language, you must satisfy yourself that they do in fact provide evidence of the seller or buyer's identity. HMRC may require official translations when inspecting your customer due diligence records. Typically, enhanced due diligence will involve verifying the identity of the individual you are dealing with, as you would with standard client due diligence, verifying an accompanying photo ID document, and this may involve the client providing their identity documents to a recognised independent professional, maybe a bank or a financial institution, a lawyer or notary for authentication. But they must forward the authentication statement and copies of the ID document onto you. Or it might even be that you verified the validity of the documentation electronically. It may be your policy to implement additional checks, such as confirming ownership details of the property with Land Registry, taking further steps to verify the source of funds, or ensuring any payments are made through a bank account with the same name as the seller or purchaser. And this list is not exhaustive, but indicative steps that can be taken. And as with all compliance activity, it is important to establish a process, have your staff trained, and evidence your activity. Landmark provide a range of electronic solutions to help estate agents demonstrate compliance with the money laundering regulations in line with your own risk assessments. Compliance in a Box, it's a pay-as-you-go compliance toolkit for estate agents with a complete range of checks to help with your standard and enhanced customer checks. Using electronic data is more thorough than using paper methodologies, as clients invariably have different levels of information that they can provide. Dealing with foreign nationals and those not resident in the UK presents a challenge to agents, and it can be a more manual process, as we've discussed earlier. Where your money laundering policy identifies it, foreign national checks can help you to fulfill your enhanced due diligence. Once you have established the initial checks on your foreign client, you can use the foreign national check that we provide to verify electronically the documentation you have been provided is not fraudulent. You are required to upload an image of the front and back of the ID, and the checks come back in two interpreted formats. either pass or refer, which you can see here on the slide. A pass verifies the validity of the document, and a refer would suggest that there is an issue with the documentation which requires further investigation and a further level of enhanced due diligence. Thank you very much for your attention to you all today. I hope you have found this useful, and if you do have any queries or indeed are interested in finding out more about Landmark or how we can help, then please don't hesitate to get in touch. My details are here on the slide, and also if you've got any questions at all from anything today, please don't hesitate to get me in touch. Thank you so much everybody, and I hope you all have a great day.